It's my favorite time of the month. Treb's Market Watch report is out, and once again, it's going to create a bunch of confusion because the way the information is presented and the way people interpret it. So what is the issue? The issue is we're comparing 2023 data versus 2022. 2022 was an anomaly year, which makes it very difficult to get any sort of insightful analysis done comparing 2023 versus 2022. My solution is simple. I've taken the last 15 years of data for the GTA and I've developed my own seasonal trend lines in terms of how the market should behave based on 15 years of data. This is for pricing, sales, absorption, new listings, active listings, etc. All the important stuff. And with this data, I take the Treb's actual results and find out how the market's actually doing relative to what a normal market would be. If you like this type of content, please like the video, subscribe to the channel. My name is Vas and I'm a real estate broker right here in the city of Toronto, trying to help investors and families navigate the insanity of our real estate market. Now let's get into the video. Let's start off with the most important chart, the one most people look at, and this is a quick recap. Seasonal price gains and losses based on seasonality. So the black line right here is typically how a seasonal market in the GTA works. In general, our prices will appreciate by 9% year over year. And the way it happens, most of the gains happen, in the spring market where we get up to, 12.76%. Then they go down in the summer, then they go back up to 12.38, and then they come back down. So this is the seasonal norm. What happened this spring? We had a massive run up all the way into May where, prices went up by 16.5%, which is not normal. As you can see, typically this time of the year, we're up 12.76, but we're up by close to 4% above and beyond that. So this is how you know if prices are going up, are they going up more than the relative seasonal norm or not? So this gives you that idea. We've had a massive drop off in sales prices going into the summer. So last month when I did this report, we dropped all the way back to 9% for the month of July. And this is where I thought things would probably stabilize. And I thought that this is where we're going into seasonal norms. And I thought for the month of August, we would probably drop another 1% because seasonally from July to August, we drop about 1% usually. This is based on 15 years of data. But as you can see, the drop is actually significantly more. So year to date, the average price gain is 5% based on year to date data for seasonality. The year to date price gain should be at about 8%. So we're actually 3% lower than where we should be. In other words, from July to August, prices usually drop about 1%. What happened this month from July to August, prices dropped actually 4%. So they dropped significantly more than they usually do for this time of year. So prices are in fact underperforming and by a substantial amount relative to what the seasonal market does. Obviously, the big question is going to be what is going to happen into the fall market? Is this going to revert back and start increasing or not? I have my thoughts on this. I think we probably peaked out here in May. I think we're going to see a bit of a pop in prices again, but I don't think we're going to hit these seasonal norms because there's just a lot of pressure on the market. And I'm talking GTA at large. I think certain pockets of the GTA will probably do okay. But in terms of this line coming back up here, I highly doubt it. So I probably expect a flat or maybe just slight increases, but nothing that's going to bring us back to seasonal norms. This graph right here is arguably one of the most important ones. And this is the one I closely watch because I feel this is what is going to indicate how the following month is going to play out. So in this case, the thick red line is basically the new listing median. So based on 15 years of seasonality, this is what new listings usually look like on a month-to-month basis. Now take a look what happened. We started following our trend line in about June. So prior to June, we were severely underlisted. So we had way less new listings relative to the norm. But what ended up happening in June, we started hitting new listings to be at seasonal norms at 16,000, 13,000, and then in August, 11,000. So as you can see, the last 3 months for new listings, we've been exactly on trend. This is very important because once this line starts going above trend, then we're going to be in a bit of trouble. But so far, we're following trend. It's starting to increase a little bit here in August. Obviously, in September, we're entering the fall market. A ton of new listings are coming on. I have a bunch coming on the market. So we know we're going to go back up, but is it going to be the 15,000 we usually get, or is it going to be higher? That is the big question mark. I have my thoughts on that, but hang on. Let's take a look at the biggest elephant in the room, and that is your absorption or how many properties we sell, which is the green line. So on average, based on seasonality of 15 years, in August, we usually sell or absorb about 7,500 properties. So far this year, we're under 6,000 properties absorbed. Now, when I did this video, the important thing that I noticed was in July, as you can see, the trend of absorption was going down faster than seasonal norms. So seasonally, usually we're selling less in the summer, which is normal, which is this gradual decline. Then it kind of goes flat in the fall market. But what I was concerned is from June to July, the absorption actually went significantly lower. There's a big divergence. And I thought to myself, you know what? We might be in for a rocky fall market. But then as you can see here, the trend line actually stabilized. So we started stabilizing sales, meaning we're still absorbing or selling less than we usually do. So instead of the 7,500 we should have been selling, we're absorbing less than 6,000 still to this date, but the spread between these two lines is getting narrower, which is a good thing for the market. The issue here is that this has a compounding effect because we have been absorbing less than normal for the last 3 months, yet new listings are at seasonal norms. So that means a lot more listings are sitting unsold and they're probably getting relisted the following month and the following month. And this compounds, and what could happen is in a few months' time, we might get a ton more new listings while absorption still remains fairly low. This is definitely going to be a chart to keep an eye out on because if this does not improve, I suspect we're going to have a lot of issues. And I'm saving the last chart, which is a little bit of good news here. Basically, we're going to look at median active listings versus actual active listings. This is important. So the black line is giving us the seasonal norm. So effectively in August, we're supposed to have about 16 to 17,000 active listings, whereas actual 2023 active listings for August are about 15,500. What this is telling me is there's resiliency in the market. Sellers don't actually have to sell. So if they can't sell for what they want to get, usually they'll be able to terminate. Obviously, this is not for everyone, but for the listings that have come on the market so far, we can see that some people can afford to just remove the listing and just stay on the sidelines and wait for a more favorable time to sell, at least for now. The other set of good news is that the Bank of Canada announced today that they're going to hold rates the same, so they're not going to raise rates. Not that even if they raised rates, it was going to have any material impact on purchasing power. However, it does change market sentiment, buyer sentiment, seller sentiment, because you have people now more confident to transact, although you have to be very careful because we're not out of the woods. In fact, I mean, depending on who you talk to, I mean, we still haven't felt the pain from the rates that we've had up until this point. And if anything, the pain from the rates is going to be felt within 18 months. And we're in that 18-month mark where this fall market is going to be very interesting. We're going to see how it plays out. I will update this next month after the September market. I'm going to be very active. So I'm going to have some anecdotes to share as well. I'll see you in the next one. If you have any questions, just text or email me.